Hello, hello, hello. Happy Thursday. Thank you for joining for yet another live event where we unpack different aspects of multifamily underwriting and deal analysis one step at a time. For those who may be tuning in for the first time, my name is Vessi Kapulian, former commercial lender turned real estate investor. I actively invest in apartments today. And I also work with investors who are looking to diversify their portfolios and connecting them to well vetted cash flowing investments in apartments. I also help investors perform due diligence on a deal, specifically as it relates to the numbers and the underwriting. And so in today's pop up, I actually came across an article that is very, very timely that I want to share with you. So let me see if I can share my screen because I think that's very relevant, especially it was unplanned actually. I do weekly newsletters with various case studies as well as educational topics related to apartment underwriting called the Multifamily Underwriting Minute. And so uh, the topic for this week's newsletter was debt yield, and that very nicely ties to the article that was released today. And so, according to Trepp, 23 billion in CMBS loans face a maturity drag, something that I actually talked about in my last live event. And I shared some of my hypotheses, and a lot of the data that is starting to emerge now is confirming that hypothesis. So, according to the article, a growing number of loans are going past their maturity dates, whether through formal extensions or by lingering unresolved beyond them. In the latter category, more than 23 billion in CMBS loans now sit past the maturity without payoff, liquidation, or extension, up from virtually zero in 2019, according to Trepp, coining the term maturity drag to characterize this status. Although this phenomenon initially occurred in CMBS tied to retail properties emerging from the pandemic, now it's concentrated largely in the office sector, according to Trepp. Retail, lodging, and multifamily loans still are part of the total, but in progressively smaller increments. Trepp reported that two key performance metrics, namely DSCR and debt yield, underpin delays in low resolution. The firm determined that risk is no longer concentrated solely among the weakest loans. Even stronger performance are becoming more likely to experience delay. The role of debt yield is becoming more prominent while DSCR roles is diminishing. Loans with lower debt yield are increasingly prone to lingering, pointing to refinancing constraints as a growing driver of delays rather than credit quality alone, according to Trepp. And so I wanted to share this with you, and I'm going to go over the concept of debt yield for those of you who may not have caught the newsletter or maybe hearing this for the first time, but it's a metric that many investors often overlook, or maybe they're not even aware about it. But as a former commercial lender, that is one of many KPIs that we often look at. And what debt yield is, you can think of it as the inverse of leverage metric on a loan. Effectively, it takes NOI, divides it by the loan amount, and that's how you get the debt yield percent. And all else equal, it basically focuses on the NOI aspect or the operating cash flow, and then the principal loan balance. So what it actually does tell to a lender, or what it measures for a lender, is all else equal, if I was to take over this deal at this NOI level, how quickly will I get my loan principal paid back? Typically, real estate loans have longer term maturities. On the short end, you have 3 years, right? On the longer end, 10 years. So in most cases, what type of debt yield lenders target would really depend on the asset class, asset quality, asset locations, but it's not uncommon to see a range anywhere from 8 to 12%. So if we just pick the midpoint of that number, say 10%, what the debt yield of 10% would effectively be telling you is that all else equal, if NOI does not fluctuate, does not change, I'll be able to get that loan principal paid back over a 10-year horizon, with 10% being paid year over year. Well, the challenge that a lot of loans are facing today in commercial real estate, and again, I'll speak specifically for multifamily, and I shared a lot of these factors in prior lives as well as my live event last week, right, is the cash flow compression, right? We have declining rents. Now they're starting to stabilize or flatten out in a lot of markets. And again, rents are hyper local, but at the national level, they're mostly flat. Then you have increase in expenses for a variety of reasons: property insurance, taxes, cost of labor, materials. And then the debt service, right, on a lot of loans has almost doubled because interest rates have doubled over the past couple of years. So all in all, that's compressing the overall cash flow that after debt service that a property is generating. So a lot of operators, right, are squeezed pretty tight. But as I mentioned, that yield is based on the NOI. So even if you put the debt service factor aside, right, the NOI in many properties has faced compression due to the market factors that I just shared. And so when that's the case, and you also have expansion of cap rates, right, a lot of these loans that are now coming due, for an operator to refinance that loan amount, they're looking at a pretty substantial pay down of principal to bring it back to a profile that's more amenable to the lender. And so for a lot of lenders, as they're facing a situation where the NOI has probably declined or is squeezed pretty tight, then the loan balance is maybe constant if it was an interest only facility, or maybe it amortized slightly over the course of the last 3 to 4 years. Now they're facing a situation where the debt yield has declined, meaning all else equal, it's going to take them even longer to pay down that loan balance. So how are they controlling for it? Well, if you're an operator facing that situation, you're probably having conversations around substantial loan pay downs. And in some cases, there are secondaries coming in the credit markets that maybe have a higher risk appetite, or they may be able to take over or refinance these credit facilities. In other situations, if you don't have deep enough pockets, right, to contribute additional capital, you're probably doing capital calls as an operator, and as a passive investor, you're probably seeing or getting a lot of these notices, or bringing in, with lenders' consent, of course, additional partners in the form of preferred equity to help with such loan pay down if your desire is to continue holding the property. In other cases, you may be forced to sell the property, and hopefully you're selling it at a price point where you can at least protect the principal of your investors, or the capital that your investors contributed. But in some cases, and I discussed an example in my last live event, it's not uncommon to see complete or partial loss of capital. And of course, lenders are struggling with that as well, because they don't want to be in a situation where you have massive foreclosures, write-downs. Yes, it's easier to do a one-time reset, but imagine what that would also do, right, to the lender's P&L and balance sheet, to overall property values. We actually saw that happen in the single family space, right, in the residential space in 08, 09. So the story is not over yet, is all I'm saying. But I thought today's, in terms of how multifamily will evolve, I personally don't think we've seen the worst of it yet. And again, for borrowers with a good operating history, good track record, sufficient margin in the deal, we're probably going to see more extensions coming down the pipe. And in some cases, as the article suggests, they're just sitting and waiting to see what will happen. So the story continues, but I did want to share it with you because unplanned for, it highlighted one a very important key performance indicator, or KPI, or metric that many investors often overlook, but it is an important one that helps a third party like a lender judge the um, financial status and financial quality of the property. So I really enjoyed being back. I usually pop in every Tuesday or Thursday around noon Pacific time. So hope to see you at future live events. To get notified, follow me on YouTube and LinkedIn. I will be hosting a masterclass on August 14th at 5 p.m. Pacific, where I will walk you through my exact blueprint for underwriting multifamily deals. I will include the link in the comments, but you can also find it under the events tab under my profile. But again, follow me and subscribe to be notified of that and future events. And I wish you a blessed Thursday. Ciao.